Victoria has just implemented the biggest change to commercial property tax in decades. As of 1st of July 2024, the new commercial and industrial property tax has replaced the previous stamp duty system, allowing investors to spread their tax payments over a decade. This isn't just a minor policy change, it's a complete reimagining of property taxation that could reshape the market. That's why in this video, I'll break down what CIPT is, how it works, what it could mean for investors, developers, and the broader economy in Victoria. The first thing we need to understand about CIPT is how it has changed property transactions. Before July 1st, 2024, when you bought a commercial or industrial property in Victoria, you paid stamp duty up front. It was a one-time payment based on property's purchase price. CIPT has changed this. Instead of paying stamp duty, you now pay an annual property tax. This could make it easier for some investors to buy property as they don't need as much cash up front. So why did Victoria decide to make such a significant change to its property tax system? Well, for years, economists and policymakers have recognized that stamp duty has an inefficient form of taxation because it essentially penalizes those who need to buy or sell property, including businesses looking to expand or adjust their facilities. This has ultimately created a barrier to growth and job creation. At the same time, Victoria has faced competition from other states, particularly South Australia, which took the bold step of completely abolishing stamp duty on commercial and industrial property without replacing it with another stamp duty. This put Victoria at a distinct economic disadvantage, with businesses potentially looking to relocate to states with more favourable tax environments. The Victorian government claims that this reform will result in a $50 billion economic uplift because by removing the upfront burden of stamp duty, businesses should find it easier to invest, expand, create jobs in the state. I must mention though that Victoria's approach is more complex than South Australia's outright abolishment. The new system involves a 10-year transition period before the full implementation of CIPT. During this transition period, you can either pay the full stamp duty upfront, as was previously required, or opt for a government-facilitated transition loan to spread this cost over the 10 years. If you choose to pay your stamp duty over 10 annual installments, the total amount would be equivalent to the upfront stamp duty plus interest. CIPT will then be fully implemented after the 10-year transition period. At that point, you will pay an annual tax set at 1% of the unapproved land value. This transition period creates some interesting dynamics for both short-term and long-term investors. For short-term investors looking to flip properties quickly, the option to defer stamp duty payments could be attractive, potentially freeing up capital for renovations or other investments. On the other hand, long-term investors need to consider how CIPT will affect their holdings after the 10-year transition period ends. The annual CIPT payments could impact your cash flow and overall returns, especially for properties held for extended periods. So it goes without saying that this is going to fundamentally shift the commercial and industrial property landscape in Victoria. Removing upfront stamp duty could make properties more attractive to buyers, potentially driving up demand and prices. But the ongoing annual CIPT might be factored into valuations, potentially offsetting some of that increase. The net effect on property values will likely vary depending on locations, property type, and market conditions. What we can say with more certainty is that CIPT is likely to change buying and selling behaviours in the market. Without the barrier of a large upfront stamp duty payment, we might see more frequent property transactions. For businesses, this change could also make it easier to relocate or expand. They won't face the steep stamp duty bill every time they need to move to a larger premise or a more suitable location. And as I mentioned earlier, investors might also change their strategies. The annual CIPT payment will affect cash flow calculations, especially for properties held long term. This could influence decisions about how long to hold on to properties and when to sell. It's also worth mentioning that properties that haven't been transacted before the 1st of July 2024 won't be subject to CIPT unless they change hands. This could create some interesting dynamics in the market, potentially making legacy properties more valuable to some buyers. Overall, while CIPT represents a significant change, its goal is to create a more efficient and dynamic property market. How this plays out in practice remains to be seen, but it's clear that both investors and businesses will need to adapt their strategies to this new landscape. Of course, CIPT is just one piece of the puzzle when it comes to commercial property investing in Australia right now. There are other major trends shaping the market that could completely change your outlook on commercial real estate investment. If you want to get a comprehensive view of the current commercial property landscape, Steve recently recorded a video outlining 3 major trends for commercial property in 2024 that might just change your perspective on opportunities available in the current market. So make sure to check it out. Thanks for watching.